Hi, students. How are you? This is Chapter 10, Itemized Deductions. Deductions and losses, certain itemized deductions. Now, we're going to talk about what's the difference between deductible and non-deductible personal expenses. So there's some expenses that you might have that you can't deduct on the tax return. And there's some expenses that are personal that you might have that you can deduct on the tax return. Some examples of deductible expenses are medical expenses. Now, not all of medical expenses are deductible, but some are. Deductible taxes and non-deductible fees. So we're basically going to talk about personal and business deductibility. Federal income tax, property tax, deductible or non-deductible interest, charitable contributions, and some other expenses. So to summarize it really, on our Form 1040, you have adjusted gross income. And any deductions above this line are deductions for AGI. Anything below this line, Schedule A or qualified business income, whatever's on Schedule A, are from AGI. This chapter is mainly going to deal with what's personal expenses. So personal expenses are on Schedule 1, that's income. Adjustments to income are the deductions on Schedule 1, and then our Schedule A. On Schedule 1, page 1 is our additions to income. On our Part 2, or page 2, health savings deduction. We're going to talk about that today. The deductible part of self-employment tax. We're going to talk about IRA deductions, student loan interest deductions. We're going to talk about some more on Schedule 1. Those are all above the adjusted gross income line, so they are adjustments for AGI. That's all, just above the line. From AGI, which means you're taking the amount from this number, subtracting from this number, is Schedule A. Schedule A is medical expenses, which is limited to 7.5% of your AGI. Your AGI comes from here, line 11. So it's really important that you have as many deductions and everything correct for your AGI, because this AGI is needed to be calculated before we can do other calculations on Schedule A. We're going to go over different taxes that you pay, state and local income taxes or general sales tax. We're going to go over real estate taxes, personal property taxes. You're going to add them all up. And if this number is $12,000, sorry, if this line is $12,000, adding all these up, A, B, and C equals D, enter the smaller of line D, 5D, which is 12,000, or 10,000. Which number is smaller, 12 or 10? 10. So there's a limitation on taxes of $10,000. So you can't deduct more than $10,000. This was a new thing that happened in 2017. This line here wasn't there prior to 2017. Interest, if you buy a house and you get a mortgage and you pay interest and points, I'll go over what those are. Investment interest, we're going to talk about that, and then we're going to talk about charity. Casualty and theft losses for a federally declared disaster, we did in a different chapter. And these other itemized deductions, which there are none really, because they were taken away between 2018 and 2025. That's what this chapter is about, is the difference between personal deductions that are above the line, basically on Schedule 1, and then below the line, basically Schedule A. And there's some exceptions. John and Kira Williamson, a young professional, have been renting an apartment in Atlanta since they were married. Their income has grown and they've become more established in their careers. They now believe the time has come to buy their own home. In addition, they desire to buy a home now, maybe coming at a good time because John's mother, Martha, needs to move in with them due to her declining health, and their current apartment is too small to accommodate her. John and Kira's current monthly rent is $2,000, but they're willing to spend $2,600 on an after-tax basis for their first home. So they're like, think about it for yourself. You're thinking about that you're renting and you're ready to buy a house. So you're going to do calculations of what it would be to rent for $2,600 in a certain way by taking money from savings, taking money from your 401k, and figuring out what that looks like from a tax perspective. Or you're going to get a mortgage and see what that would look like from a tax perspective. And that's what this chapter is about. What's the right answer? Should they take it out of their savings, or should they take it out of should they get a mortgage? After months of house hunting, they found the perfect home. They are concerned it may be too expensive. If they acquire a standard mortgage to finance the home, the total cash outlay in the first year will be principal payments, $2,000. Interest payment, $37,000. Real estate taxes, $4,000. Okay, well, we know here the $37,000 and the $4,000, those would go on what schedule? Schedule A. Real estate taxes, $37,000. Sorry, real estate taxes is $4,000. So what's smaller, 4 or 10? It's 4. Okay. Interest payments is $37,000. Home mortgage interest is $37,000. The principal is paying back the loan. That's not something you can take. So that's what they would have, a $43,000 a year. Now, $43,000 a year divided by 12 is $3,583. So that might be a little bit more than what they're willing to pay, which is the $2,600. So let's see where they go. If they use their retirement and taxable investments to secure the home financing, they can qualify for a low interest rate and therefore reduce the interest from 37 to 35. Okay, reduces it to 35. Now, if they use their retirement and taxable investment, that's not a mortgage. That's not a mortgage. So they wouldn't get this deduction at all. They expect their AGI to be about $200,000. So on our page 1, let's just pretend that we have everything filled out, and they think it's going to be about $200,000. And they're married, so married filing jointly would be $27,700. So their standard deduction would be $20,700. So are they going to itemize? Will their Schedule A be more than if they got the $37,000? Yeah, they get a good hit here. If they did the $37,000 here, that 37 is greater than 27,700. Plus, it's 37 plus 4. This is just what we know so far. 37, we don't know about their gifts and charity, but 37 plus 4, 37, 38, 39, 40, 41. We don't know. We know if they have medical. So far, it's 41,000, which is greater than the 27. So they might want to look at this. So this is helping them get a bigger tax deduction so far. John and Kira have not itemized their deductions in prior years. That doesn't matter. Each year you can do the calculation and you can go back and forth. because their qualifying expenses had been too low. They didn't have an interest, mortgage interest, or anything like that. Assume that the Williams face a 6% state income tax rate. What are itemized deductions? Itemized deductions are on Schedule A. Medical, taxes that you pay, interest that you pay on a home mortgage, that's it. And investment interest and gifts to charity and casualty. That's your itemized deductions. Medical, taxes, interest, charitable organizations. You'll elect to itemize when your itemized pieces are larger than your standard, right? So on our 1040, my standard is 27.7 for married, but I might itemize. If my itemized is more, I'm going to take the itemized because I get more of a deduction. Back to the facts. John and Kira discovered that they will purchase that with the purchase of a home, they will be able to itemize their deductions for the first time instead of claiming a standardized deduction, which I just described to you. The home mortgage interest and real estate meet the requirements and they can be deducted from AGI. Their total will exceed the standard. So that's what they're looking at. They're itemizing that. Other expenses up to $10,000 for state as well as charitable could also be deducted. So medical expenses, there's a floor, 7.5%. So what is on Form 1040, line 11? 1040, line 11, that's your AGI, $200,000. So you put $200,000 here. Multiply line 2 by 7.5%. 200,000 times 7.5%. Is $15,000. That means this is the floor. So what are their medical expenses? If their medical expenses are $15,000, if line 3 is more than line 1, you enter 0. So you subtract line 3 from line 1. 15 from 15 is 0. So anything above $15,000, if it was $16,000, they'd be able to deduct only $1,000. So this is the floor. Anything above this can be deducted. That's the floor. Okay? So anything above the 7.5% can be deducted. This is for medical expenses. What are they? They are something to diagnose, cure, mitigate, treat, or prevent disease or affecting anything of the structure or the function of the body. Go to the doctor is bad. Costs that you cannot include. Unnecessary cosmetic surgery. Okay. General health items like what do you call those things? Supplements, Band-Aids, anything that would just be just general health items. Non-prescription drugs, those are not medical expenses that you can include on this line. On line 1, medical expenses, they cannot be included. But if there's cosmetic surgery, it could be deductible if it's necessary when it improves the effects of a deformity from a congenital abnormality. A personal injury, you got into a car accident and messed up your face, or a disfiguring disease. Those would be medical versus, oh, I don't like the way my nose is. That would be unnecessary. Sorry, my dog's barking in the background. You all right? What do you hear? Sorry. So, if, as expected, the Williamson's AGI is $200,000, okay, so $200,000 times 7.5 is a 15,000. I already went through this to you. So if they have a $27,000 of unreimbursed medical expenses, so we'll go to that thing. If it's 27,000, then they have how many? How much can they deduct? 12,000. 27 minus 15. Okay. What are some examples of what's deductible versus non-deductible? You can read all those. You probably should have already read the book already. And these are more deductible versus non-deductible. So driving to and from the medical care is deductible. Uh, things that you have to buy, cost of alcohol and drug rehab, things that are not illegal operations, non-prescribed controlled substances. Nursing home. If you are put into a nursing home to get medical care, the cost of that care, including meals and lodging, qualify. If the primary purpose is personal, I don't want to have to take care of my mom anymore, and I put her into a nursing home. Only the medical costs qualify, but the meals and lodging does not. So if they're like, for example, I used to take care of my neighbor. She was an older woman and she fell and she broke her hip before I started taking care of her. So when she went to the nursing home to rehab for the broken hip, that was all deductible expenses on her tax return. And then later on in life, when she got older, if she was going to go into a nursing home because she was old and needed to be taken care of and I couldn't take care of her anymore, only the medical costs would qualify. Tuition. This is an example of if there's a special school for mentally or physically handicapped individual, if they go there, then, so for example, I had a woman I used to work with, and she was an older woman. She's probably in her late 60s, early 70s. And she actually walked with a cane because she had been injured throughout her son's life. Her son was a 23-year-old or 26-year-old, 250 pound young man, but had the mental capacity of a 5-year-old. And so if you picture a 5-year-old throwing a temper tantrum, now put that 5-year-old's temper tantrum mindset in a 250-pound man who will pick up a chair or a table and throw it because he's upset. So she had to finally put the young man, into a special school because he was constantly injuring her. He didn't mean to, he just didn't know what he was doing. So those are medical expenses for that tuition of going to that school because they were able to manage his medicine while he was there. And, the principal reason is the special resources to alleviate the infirmities. So everything is deductible when that happens. Capital expenditures, you're putting in a swimming pool, you're putting in an elevator. These are capital expenditures for medical purposes. These are deductible. Some itemized deductions are suspended, which you can read in your book. Expenditures are only subject to the AGI floor. So again, anything that's above the 15,000, and like everybody's AGI is different. So this 15,000 is 7.5% of this number. It's not always 15,000. You can read more about that, or you should have already read about that. Medical expenses incurred for a spouse and dependent. Your taxpayer may cover costs for medical care for a spouse and a person who was a dependent at the time the expenses were paid and incurred. For paying for medical expenses, the dependent does not need to meet a gross income test. Divorced persons with children, special rules apply to the non-custodial parent. The non-custodial parent may claim medical expenses even though the children are not the dependent of the non-custodial parent. If you're driving back and forth for treatment, for example, I have a friend of mine who their daughter is Down syndrome, can't communicate, and she got lymphoma, and so they had to drive 2 hours to the nearest children's hospital to get the cancer treatment. So they drove, and then she'd stay there for the daughter would stay in the hospital for 5 days, and the husband and wife would switch off. They would be with her. One would be with her for a few hours. The other would be at the hotel sleeping, blah, blah. The driving, they got 21 cents per mile. And they also were able to deduct $50 per person per night for the lodging while they stayed at the hotel. Okay? Can't be more than $50 per person per night. So John's mother Martha moved in with the Williamsons because of her declining debt. Because of her declining health. That should be health, not death. Her health. Because of her declining health, she becomes their dependent. Later, John is advised by Martha's physician that she needs specialized treatment for her heart condition. John and Martha fly to Cleveland, where Martha receives the therapy at the heart clinic. So the round trip airfare's deductible. The lodging is $480. The transportation, the whole thing is deductible, but the lodging, it's only $50 per night per person, and it was 2 nights. Medical insurance. If you're paying medical insurance, they're deductible as long as they're not being paid as a deductible from your employer. If your employer is deducting medical insurance from your check, you cannot put that on your tax return because that's pre-tax. It's already tax-free. So you don't need a deduction for it because you didn't pay taxes on it. If you are getting your insurance through the marketplace with after-tax dollars, then you can put that premium for medical insurance on your tax return. For self-employed taxpayers, that's a business expense, which is on your Schedule 1 or your Schedule A. So on your Schedule 1, I put it right here, health savings deduction, self-employment tax, self-employed health insurance deduction. They're for AGI. And then there's other types of insurance premium you could deduct. So John is a sole practitioner and an unincorporated practice. He paid health insurance of $12,000 and his own and $8,000 for his wife. They can deduct the whole $12,000 as a business deduction for AGI on their Schedule C. The year of deduction is when you pay it. When you pay the medical expense, whether you're a cash basis, when you're on a cash basis. An exception is allowed for deceased taxpayer. It could be in the year that they actually had the expense happen, even though the estate might pay it later on. So they can choose which way they want to do it. Okay. No deductions allowed for a future expense unless you're obliged to pay it now. Reimbursed. Let's say, for example, the tax benefit rule we've talked about before is we talked about with casualty loss. If I had an expense and I put that expense on my tax return, which gave me a benefit, the benefit is it reduced my taxes because an expense reduces my taxable income, which then reduces my taxes. So if I had paid, I deducted something on a tax return because of medical, I paid some medical bill, and I put it on my tax return. I deducted that lowered my income, which lowered my taxes. In the following year, if I received a reimbursement from my insurance company, I now have to include that reimbursement as income because I got a tax benefit the year before. So now I have to pay the taxes back for what I, deducted in the previous year. If it's reimbursed in the same year, then you don't deduct it on your tax return and you don't include the income on your tax return. It's just a wash. This has only happened if it's a different year because you got a deduction for it and you got paid back. Health savings accounts. If you have a low-cost medical fund from an HSA, the annual deductible is not less than $1,600. The annual limit is $8,050 or $6,100. All right. That's the knowledge check. taxes. State taxes. What's a tax and what's a fee? Fees are not deductible. Taxes are based on what the law says, what you have to pay taxes on. So there's state and local taxes for AGI and from AGI. The for AGI are business. Business, this is for personal residence, which is from, which is personal, which is on your Schedule A. Business for AGI is above the line. Schedule 1, Schedule C, Schedule E. Above the line. Schedule 1, Schedule C, Schedule C, Schedule E. If you don't know those schedules by now, you should be, I don't know what to tell you. Real property taxes, these are from AGI, which are on your Schedule A, right? Personal resident tax, property taxes on a personal residence, real estate taxes on investment property. Those are all here on your Schedule A. Real estate taxes on your house, personal property taxes, that would be on personal property, like a car. The limit on state and local taxes is only from 2018. That's that 10,000 I told you about. That's from 2018 to 2025. It's a new thing. Which of the following are deductible taxes? D. Property taxes. Foreign real property are not deductible from these years. It used to be that you can deduct foreign property taxes, but now you can't. Only domestic. State and local on real property are generally deductible only by the person whom the tax is imposed. If I pay the property taxes for somebody else, I can't deduct it, but it's been paid, so the other person can. This is the personal property taxes, like a motor vehicle, like these are usually state taxes, like Connecticut charges a motor vehicle tax. Those can be deducted on your federal tax return. So let's say, for example, I own a house and I have property taxes of $12,000 a year. And then I decide to sell my house, and March 1st, you buy my house. So we will apportion the property taxes between me, the seller, and you, the purchaser. So March 1, you own the house. So I only owe the taxes for January and February, which is, I said it's 12,000 a year. 12,000 divided by 12 months is 1,000 a month. So I have to pay 2,000 and you have to pay 10 because you own it as of March 1. That's what the apportionment means. State and local income taxes are deductible as itemized over here. State and local taxes, even if your sole source of income is from business, rent, or royalties, because that would be state taxes that you're paying last year on your personal state tax return. So you can either deduct state and local taxes or sales and use taxes. You can't do both. So it'll all depend on where you make your money, right? State and local taxes, income taxes, are usually withheld from your employer withholds them from your check, or you are a sole proprietor and you pay your estimated sales tax, your estimated income taxes every quarter and file your estimated tax payments each quarter. For sales and use taxes, you either deduct the actual sales or use payments or use the IRS table based on your whatever it is that you purchased. So maybe last year you worked, but your state and local income taxes were a low amount, but you bought a huge boat and you paid a huge amount of sales tax for it, or you bought an RV and the sales tax is more than the income tax. Well, then you deduct the sales tax over the income tax. Assuming the Williamsons proceeds from the purchase of a home, the real estate taxes they pay will be deductible from AGI. They should review their annual registration to see what they have for a car. to figure out their taxes. They pay a registration fee of $412 of the amount. $400, which is 2% of the $20,000 value, is deductible as personal property tax. The rest of it is not deductible because it's a fee based on the weight. There's a knowledge check for you. Interest. So we have interest is compensation for the use of money. You have the interest on a qualified student loan. That's on your Schedule 1. Student loan interest deduction, line 21. Your investment interest, which is on your Schedule A, investment interest, and your qualified residence interest, which is your home mortgage interest and points. What's a point? Let's say you're going to go buy a house. So what happens? You're going to buy my house. I'm selling my house for $300,000. So you say, I want to buy your house. I say, great. Give me $300,000. You say, I don't have $300,000. Well, then what are you going to do? You're going to go to a bank and you're going to get a loan. A loan for a house or a building is called a mortgage, just the name. So you go to the bank and say, hey, can I have a mortgage? And they say, sure, no problem. And then you're going to give me whatever, 10% or 20% of it, because a bank will never give you the whole 100% of what you're going to pay me. So you're going to get, say, give me 20%, which is $60,000. The bank is going to give me $240,000. Well, then who do you pay? Well, I now have gotten the 300,000, 20,000, 20% of 300 is 60,000. You gave me 60,000. The bank gave me 240. So I have my $300,000. I give you the keys. House is yours. Well, who are you paying the 240? You're going to pay the bank back. Well, the bank is going to charge you interest for that. And let's say when you go to get a loan, they say, okay, we'll give you $240,000 at 7% interest, and they'll make your mortgage payment be, I don't know, I'm going to make it up. Let's say it's going to be $1,500 a month. And you're like, listen, can I make it? How can we make it be $1,400 a month? Because I can really afford 14. I can't afford 15. Well, what they'll say is, okay, if you want to buy a point, instead of me giving you a loan for 7%, the bank says, instead of me giving you a loan at 7% interest, I can give you a loan where you pay 6% interest, but that 1 point of a difference, give me $1,000. And then you do a calculation to see which way is cheaper. So that means you're buying the point. So let's say that our couple here, they're going to have interest of $37,000 for a year, but they also bought a point for $1,000. So you're going to put the $38,000 there. You're going to put that 1 point there. So you buy a point. It's basically paying for the interest up front. That's what that means. Personal interest expense is not deductible. You buy a car and you have to pay a car loan. That interest is not deductible. It's personal interest. So qualified student loans, the maximum deduction is limited to $2,500 per year. So on your Schedule 1, this line cannot be more than $2,500. And it also phases out when your modified AGI or MAGI is between these amounts. Qualified residence. Interest on indebtedness is secured by a qualified resident of a taxpayer. What does that mean? When you got the loan from the bank, you're indebted to the bank. It means you're in debt. You owe them money. You're in debt, indebtedness. It's secured by the residence of a taxpayer. So when you, excuse me. Oh, I don't know what just happened there. When you buy the house from me and you secure a loan, indebtedness, you're in debt to the bank, you have interest on that. That's a qualified residence because you're going to live in the house. It's secured by the house that you're buying. The interest must be on the acquisition or a home equity loan, a debt for acquiring the home, or a home equity loan. Now, when you gave me the $60,000, right? When you gave me the $60,000, how much equity do you have in the house? $60,000, because the bank owns $240,000 of it because they paid me the $240,000. So the bank actually owns $240,000 of the house. You only own $60,000. So your equity is $60,000. But every time you pay the bank a bit of the mortgage, which is part of the principal of the 240 plus the interest of 7 or 6%. Every time you pay a part of the principal, your equity goes up. So let's say every time you pay the $1,500, 200 is towards the principal. Usually it's like 3/4 and 1/4, but let's say 1,500. 500 is toward the principal and 1,000 is to the interest. Well, the 500 that you pay toward the principal to the bank is increasing your equity because now you own more of the house. So you can take a loan out on the equity that you have in your house. But if you get a home equity loan against your house, if you use that money for other than putting more money into your house, like putting in a new deck or a new air conditioning or a new bathroom or whatever, if you get a loan to do something like that, that interest is deductible on your tax return. But if you get a home equity loan and you use that money to pay off a credit card or buy a car, that interest will not be deductible on your tax return. It's only when you're using it for your house. Now, there's a limit to the interest that you can deduct here. Okay, the interest here. Now, it doesn't show you the limit here, but it tells you in the instructions. See instructions. Okay. So if the loan that you received from the bank, the debt you incurred was before December 15th, the interest that you are allowed to deduct is limited to $1 million. Because maybe you're buying a $20 million house and you have $1 million of interest each year. It's limited to $1 million. If the debt was incurred after this amount, it's limited to $750. Interest on home equity loans is not deductible unless the funds are used to improve the principal residence. Now, prior to 2018, if you got a home equity loan and you bought a car, you would be able to deduct that interest. But now you're not allowed to anymore. So given that John and Kira will need to borrow at least a portion of the purchase price for a new home, a standard mortgage will likely qualify as acquisition because the borrowed funds are to acquire a new principal residence. The interest on the acquisition will be fully deductible only if the amount of the mortgage is $750 or less. The whole entire mortgage. Okay, not the interest. Like wouldn't be $750 here. It'd be that the whole entire mortgage is $750. We don't know what the interest would be. Recall that the Williamsons are also considering what appears to be a less expensive route by using their retirement. Well, if they choose that alternative, the interest will not be deductible. You cannot deduct the interest on your retirement account, and it would not be secured by the home. So this is explaining what points are. Which I already told you. Okay, prepayment penalty. Let's say, for example, that you get a loan. And sometimes in a loan document, it'll say that it's a 10-year loan or a 20-year loan or a 15-year loan. And this is usually with, this prepayment penalty is usually with a business loan, not a personal loan, but you should read the fine print anyway. So what it says is this. It says, okay, you're buying the house from me. You're giving me the $60,000 and you're getting a loan from the bank for $240,000. And it's a 15-year loan. Let's say it's a 15-year loan and you're paying them 7%. So as you're paying it, you decide you get a big bonus at work and you decide I'm going to pay off the whatever I have left. Let's say you have 100,000 left. You got a big bonus at work and you say, I'm going to pay off the $100,000, but you really have 5 more years left. Well, every month when you pay your amount off, your calculation gets recalculated to see what your next month is going to be. So sometimes in the document, it'll say you cannot prepay your loan. Why? Because the bank won't get their 7% interest over the 15 years. And if you pay it early, then let's say you pay it 5 years early, they're going to miss out on that 5 years of interest. They'll have a rule that if you want to prepay your mortgage, you still have to pay the difference of the 5 years that you wouldn't have paid. So it's called the prepayment penalty, but it's really actually considered to be the interest that you would have paid in the next 5 years, but you're paying it all up in 1 year. So that is deductible in that year of when you pay it. Okay, and there's some more examples. Now, investment interest expense is limited to net investment income. So on here, investment interest. If you have an interest investment expense of $5,000 and you have investment interest of $4,000, so you have $5,000 of expense and $4,000 of income. That means you have $1,000 more of expense. You're not allowed to do that. So this has to be zero. And that $1,000 of expense that you didn't get to deduct will be carried over to the next year. Okay, so your deduction is limited to your income. Even if interest expense is deductible, there's some conditions that have to be met. It's got to be allowed interest, a bona fide obligation. It can't be looking like it's a gift. The debtor and creditor must intend to repay the loan. Like it can't be between families and they're not actually going to, like this one, intent can be especially crucial between related parties. It's got to be shown as a bona fide debt. It can't be something that's not really a debt to make it look like a debt so that you can get these deductions. And then you can read those. So whether the interest is deductible for AGI or as an itemized deduction from AGI, of course, if it's business, it's for AGI because it's above the line. Schedule C, Schedule E, Schedule 1. Personal use, Schedule A is from AGI. This student loan is for AGI. It's on Schedule 1. Debt for his or her employment, that's personal. It's not deductible. Here's a knowledge check. What's not deductible interest expense? All right, charitable contributions. So this is on here on Schedule A, charity. So what is charity? Charity is you are contributing to an organization that's qualified domestic organization. Qualified domestic organization means that it has filed with the IRS as a 503C, 503C3. And that means that it is recognized by the IRS as a qualified domestic organization. So for example, let's say you decide to contribute to, let's say a friend of yours is sick and some family members, they put up a GoFundMe page and you contribute to the GoFundMe page. You can't deduct that on your tax return because GoFundMe is not a charitable organization. It's a business that is used to be a third party in between a donor and a gift giver. That's a gift, but that is not a charitable donation that you could put on your tax return because you have to give the money to a 503C. So for example, so what's a charitable contribution? A charitable contribution could be money. It could be property. It could be art. It could be anything that you're giving except for services. You can't deduct the value of your services, which we're going to get to. They have to be made to a qualified organization, which means it's a 503C3. And when is it deductible? When you pay it, which we're going to get to, right? So you have to, if you contribute to an organization, they will send you a letter back saying, thanks for your contribution. You have to keep that because technically, if you don't have proof that you contributed to a 503c, you can't put it on your tax return. There have been years where I have donated to a charitable organization and I lost the letter and I forgot the name of the organization and I forgot when I do whatever. If I don't have the proof, and you can have the proof on your credit card if you show that if the charitable organization's name comes up there, you can have that too. But you have to have a receipt or proof that you contributed to this charitable organization. Because the biggest reasons why the IRS, I have a client right now, she and her husband are getting audited by the IRS because of their medical deductions and their charitable contributions. Those are the two things that are, people just throw that up there without having any type of proof of it. And then they actually get audited because you're not required to send in your proof. But if they audit you, you better have your proof. Okay. So you have to keep it. You value the donated property by the fair value. And then there's special rules if the value increases and what's the percentage of limitations of what you can deduct. So let's say, for example, I contribute $1,000 to organization X. Well, that organization, depending on what type of organization it is, I can only deduct a certain percentage based on the type of organization, which we're going to get to. So real quick, I wanted to go through my Excel file, right? Here I have some medical expenses. I want you to be, so here's my AGI, 1, 2, 3, 4, and 5. Then here's what my medical is. I want you to erase these, and then I want you to go back in and calculate them, right? So this is going to be, here's your formula, 100,000 times the 7.5%. And then I want you to tell me what the deduction is. So you should go in and, save this sheet, a second one, and go through it to show what the floor and the deduction is. And then here's your Schedule A as an example. And then this is when I'm talking about you had a medical amount in the first year of $50,000 and you deducted it, right? You deducted $41,000 of it. So let's just say that that's what you deducted because of your 7%. And then your tax rate was 20%, which is $8,200. So in the following year, you got reimbursed the $50,000. So you're going to add $41,000 to your income and pay back the 82. So then the 82 minus 82 is 0. So here's your income. This is your investment interest. You have income of $500. Your expenses $1,000. You cannot have a loss. So it's going to be a 0. You can only deduct up to the income, which is the 500. So 500 minus 500 is 0. So you can only deduct 500 on your Schedule A. You carry over the rest. This here is you're buying something. This is your mortgage. You put this down. This is about PMI, which is extra interest that's not deductible. 3 years later, you pay your mortgage, you own. This is the talking about what you own. This is your equity. So here's an example that you can do on your own: medical expenses, real estate, mortgage interest, charity. Okay, $1,000. So now, so this is for the charity now, okay? This is for your charity. So a charitable contribution is a gift of property made to a qualified organization. You have to have a donative intent, means you're just donating it. You don't want anything back. There's no consideration coming back, and the donee will accept it. So for an example, there are sometimes organizations will donate to a charitable organization, but the charitable organization won't accept it. Because let's say the charitable organization is raising awareness for, unwed mothers or something like that, right? And an organization wants to donate to them, but the organization is, a very religious organization that wants to take over with their gift, they want to take over and try to prevent this organization to help unwed mothers, because they want to try to get the unwed mothers to give their children up for adoption or something like that, right? There's really crazy people out there. So when you're talking about, then that organization will not accept that, because the donor and the donee are at odds as to what the purpose of this organization is. And if they don't agree with it, they're not going to accept money for them, because when you accept money, it means that you're agreeing to what they believe. The taxpayers, the burden of establishing the transfer was made. Okay. No deductions allowed for services. So let's say I'm a CPA and I decide that I'm going to drive to New York City and I'm going to offer my services and do the tax returns for a not-for-profit. Well, my services are worth $200 an hour. Well, I can't deduct the services, but I can deduct my travel time back and forth if I drive back and forth. Unreimbursed expenses. Maybe I went down and I stayed over and I had to buy meals when I was away. All of those expenses I incurred to do the work, I can deduct, but the actual cost of my service, I cannot deduct. So these are not deducted as charitable contributions. Dues, cost for raffle, lottery tickets, tuition, if I gave tuition to somebody else, payment for the right to purchase tickets for seating athletic, all value, I gave blood, I gave money to a Donate Homeowners Association, gifts to individuals. That's not charity. That's something that would be put on your gift tax return. Rental property. Now, gift cost, let's see what a planning thing would be here, okay? So there was a long time ago, I don't know, maybe 10, 15 years ago, Pierce, forget his last name, he has a talk show. He had two of the Kardashian sisters on. And, you know, they talked about the fact that 10% of what they make goes to charity, because their father had always taught them that. Before he died, always 10% of what you make goes to charity. So as I described to you, that you have to give money to a 403C for 503C, 503BC, 503 something, I keep forgetting, it's 503CB, I think it is. So a lot of wealthy people will create a charitable fund. They'll create a charitable fund where, I think it was, let's say Kim Kardashian created a Kardashian charitable fund, and she had it registered with the IRS as a charitable organization. So then Kim would donate to that charitable fund, which would be a tax deduction for her because it's a 503. And then she might turn around and pay the tuition to a bunch of underprivileged people to pay for their college. So if she went straight and paid for the tuition of those students, it would not be deductible on her tax return. But because Kim herself contributed to her charitable organization, where the funds go to help charitable organizations that are maybe not registered for the IRS, she can deduct it because she created a fund. So that's what a lot of very wealthy people do, is they create a charitable fund, which is a 503C, as long as the money that's going into the fund is going to go out to pay for some kind of charitable thing, but it does not have to be a 503C, because a 503C, that charitable organization is a 503C, but they don't have to, the money spent doesn't have to be to another 503C. It just has to be helping out in charity. So that's a strategy for planning strategy. What's a qualified organization? State or possession of the United States could be one of these types of organizations. Gifts for needy individuals are not qualified organizations, hence not deductible. But for example, that would be something that if you created your own charitable fund and contributed to it, and then you then gave money to the needy, then that would be okay. So like, for example, the fund would have to have a charter. the Kim Kardashian fund would have to have a charter, or your name, blah, blah, blah fund would have to have a charter. And the charter would say, the purpose of this charter is we are going to give tuition to underprivileged students. Or it would say, we are going to give money to the needy in the Los Angeles area, whatever. Whatever the charter says, that's how the money should be spent. Time reduction is in the year of payment, both cash and accrual basis people. Read the rest of that. Record keeping, no deductions allowed unless you have the documentation. So there was times where I made donations in years and I couldn't find the records, and I just didn't put on the tax return because I didn't want to get, if I got audited, I wouldn't have had the documentation. Valuation, property donated to a charity is fair market value the date the gift is made. If I had a car that I bought for $20,000 and I drove it for 4 years, and then I donated it to like cars for kids, what's the value of the car that when I gave it to them? It's 5 years old, probably $5,000 maybe. The gift I'm giving is $5,000, not what I bought the car for. So now here's the calculation, okay? If I contribute to charitable organizations, the total of my charitable organizations, if they are a total of 20% or less of my AGI, everything's deductible. Okay? If the amount that I'm deducting is more than 20%, I now have to limit it 20%, 30, 50, or 60, depending on the type of organization. The maximum amount cannot exceed 60% of my AGI for the tax year. If I exceed, I have to then carry it over. So here's an example. Step 1, if the charity is less than 20%, it's fully deductible. So my AGI is $200,000. 20% of AGI is $40,000. If I contributed charity of $30,000, it is less than the 20% of my AGI. It's $30,000, so it's fully deductible. My AGI is $200,000. My 20% of that is $40,000. I contributed $60,000. It's over $20,000. So now I look at step 2. So this depends on, if it's more than 20%, it's limited to 20, 30, 50, or 60. The percentage depends on what type of organization you're contributing to. So let's say I contributed $70,000 to this type of charity, $120,000 to this type of charity, $70,000 to this type of charity, $35,000 to this type of charity. So the percentage depends on the type of organization I'm contributing to. So what's my ceiling? My ceiling is my AGI of 200,000 times 60%. My ceiling is my AGI times 50%. My ceiling is my AGI times 30%. My ceiling is AGI times 20%, which means that I can only deduct up to 120,000. So I have $70,000 I contributed to this type of organization. I can deduct anything up to 120. So I can deduct the whole 70,000. So there's nothing to carry over. This 60% is temporary between 2018 and 2025. I have $120,000 I contributed to this type 50% organizations. My ceiling is only 100,000. So I contributed 120. I can only deduct 100,000. That 20,000 difference I carry over to next year, and I keep it in that category. I contributed 70,000 to my 30%. My ceiling is 60, so I can only deduct 60. So that $10,000 difference, 60 versus 70, I carry over. 35 is 40. I can deduct the whole thing. Now, the last thing says the maximum charitable contribution deduction may not exceed 60% for the AGI. What's 60% of my AGI? 120, right? 60%. 120. So I can't deduct all of this 195 because it's above my 60%. So I would take pieces of it out so that I would carry this over. So 195 is 75,000. So I would probably take it out of, I would want the larger deductions to be there, and I would take it out of the lower deduction. So I'd probably take all of this 35. I would put that as 0 and carry it over. So now I'm at 160, and I would take 40 from here. 50, 40 plus 50. Minus 50. No, make that 50. Minus 10. Nope, I did that wrong. 40, sorry. No, I want it to be 20. Oh, let me try this again. Minus 40. Okay. But I have to take this out. That's why I was messing it up. So I'm gonna keep it what it was. Okay. And I would say adjust the lower percentages to get the 195 to 120. Okay. That's what that amount is there, right? Whatever is not deductible carries over but stays in the same category. Okay. Ordinary income property. If any property that if sold will result in the recognition of ordinary income, then that would be the fair market value less the income is what's going to be deducted. Property that would be resulted in recognition of long-term capital gain if it was sold, that contribution amount is deductible. Generally, just again, the fair market value with some exceptions. That 50% ceiling, this 60% is temporary between 2018 and 2025. So what they are the 50% ceiling are churches, schools, hospitals, federal, state, local governments, private foundations. That's the 50% ceiling. The temporary 60% is because of what was going on with COVID, they felt that there was going to be a drop in charitable donations because of what was going on. So that's why they put the 50% to the 60%. The 30% ceiling is for cash and ordinary income property. The 30% also is for appreciated capital gain property. So it's a type of property. That's what the 20% is for capital gain for private non-operating organizations that are not 50% organizations. So it's the type of property that you're contributing to. Okay, so whatever you don't use, you carry over, but you keep it in the category of percentage. All right. Timing of payments. You can use a standard deduction in 1 year and itemize in another year. You can shift from 1 year to another. It's not a big deal. Okay. And then you have this knowledge check you can read. Other itemized deductions. These are no longer deductible. Gambling, well, if you have gambling losses, you can only, the same as like investment interest, where it's limited to your income. Same thing with gambling losses. If your losses are greater than your income, you can only do five. Let's say your gambling income was 500, your gambling losses were 1,000. You can only deduct 500 losses against your income, because you can't have a loss. You can have only zero, or you can either have zero or winnings. Impairment related work expenses of a handicapped person. It used to be that you can deduct unreimbursed employee expenses, but all of these are taken away between 2018 and 2025. These were things that used to be deducted but aren't anymore. So this unreimbursed employee business expense is not allowed. However, if you are an impaired person, you can. Estate tax for someone who died is deductible. Repayment of a claim of right, if more than $3,000. So again, these are things that used to be deductible and no longer allowed. And then there is your knowledge checks. So, and then you refocus on the big picture. Because the federal law provides qualified resident interest and real estate deductible taxes, a home purchase will be reduced by the tax savings for these itemized deductions on Schedule A. Since the Williamsons' projected income, they're 24% federal and 6% state. So they'd have $2,000. 37 plus 4 is their taxes, minus the 30% of taxes that they would have to pay is 28,700. So the total is 30,700. Divided by 12 is 2,558, which is less than their 2,600 they were thinking. So purchasing a home would be affordable. What if they, and here's some changes, what if you can read those what ifs. Okay. And then there's some more summaries there. So if you have any questions, please reach out to me, and hope all is going well.